welcome back to Mr. C's Accounting, and we are looking at capital assets now. So we're in new territory, and we're looking at the recording of big assets like computers or offices, machinery, vehicles, buildings, raw materials. I think I said that, I'm not sure. But anyway, it doesn't matter because we're going to the next slide. So what is a capital asset? First of all, it's not for resale to customers. Its main purpose is to support the production and sale of goods and services, and it provides benefits over many periods. So these are the three criteria that any asset has to meet in order to be classified as a capital asset. And there are two main categories within capital assets. And the first is tangible, so it can be touched. And the second is intangible, meaning it can't be touched. So tangible assets are lumped up into two categories, or two subcategories. Now the first category, and this gets a bit confusing, but the first category is property, plant, and equipment. Those are all under the same subcategory, even though they're different things. And the reason they're in the same category is because they're treated almost exactly the same way. And we'll get to that later. Natural resources are treated differently because natural resources are used up over time. So with things like property, plants, or equipment, you have a set piece of equipment, or you have a set plant, or you have a set piece of property. And although it may change over time, it's still a piece of property, it's still a plant, still equipment, and it doesn't get used up. It may require maintenance and stuff like that, but it's still a piece of equipment. You see what I'm saying? Natural resources, on the other hand, get used up. And when they're used up, they're gone, and the more they're used up, their value has to change according to that. So, and intangible assets are things like brands, which carry a lot of value, but you can't physically touch them. Did you guys know that Coke's brand is worth more than all of the tangible capital assets put together? I think I read an article a few years ago saying that Coca-Cola's tangible capital assets added up to around $56 billion ish. Now this was an article from a while ago, but they estimated the brand's value to be worth $70 billion, and you can't even touch it. So it's definitely something that we have to account for. Now we may not be able to cover intangible assets due to the reduced content in teaching due to COVID-19. That's something that I'm going to have to investigate. But anyway, I just wanted to let you guys know that there are two main asset categories within the capital asset umbrella. So moving on. So we're going to start off by looking at property, plant, and equipment. So when you acquire property, plants, or equipment, there's something called the initial recognition. And this happens at the date of purchase. And what you do is you record the piece of property, the plant, or the equipment, regardless of whichever capital asset we're talking about. You record it at its historical cost in accordance with the cost principle. So it's not the current market value, it's what you spent to acquire it. Now, this is where things get a little bit interesting and potentially a little bit complicated. Is that cost also includes the acquisition price plus any expenditures made to make it ready for its intended use. Now this is a broad term. You know, this could cover anything from freight to installation to paint jobs or repairs. You know, it really depends. But if you buy a truck to do deliveries for your company, but it's all rusted and dinged up, then when you're recording the cost of acquiring that truck, you would also include in the expenditures part, the repair work and the paint job done in order to bring the truck up to a certain operational standard so that it can function properly. So how is cost measured? Most obviously, this is the sort of the most apparent way that it's recognized, or it's measured rather, is the cash that's paid. Now, cash here is used generally speaking. If you paid for it on account, that's a different matter. But it's the money, usually it's the money you paid to get it, but there are other ways that you can acquire capital assets that don't directly involve money. For example, what if you obtain a capital asset in exchange for a non-cash asset? Any Fast and Furious fans? You guys remember the car-for-car races they used to do? And that can happen. Now, I mean, you're not going to see two 70-year-old executives climb into their Porsches and race each other to see if they can acquire the other's car. But often enough, trades will happen within an acquisition of a capital asset. And so when that happens, we use the cash equivalent price. But the important note of a cash equivalent price is that it's the fair market value of the asset given up. So to sum up, if you don't pay cash for a capital asset, if instead you trade, then when you record it, you record the fair market value of the asset that you gave up, not the asset that you got. So it's tricky, you got to remember that. But I'll say it one more time, when you're acquiring an asset and you're not acquiring it with cash, then you record the fair market value of the asset that you gave up, not the asset that you're getting. Now, if this is not determinable, so you can't figure out what the fair market value is, the default cash equivalent price is the fair market value of the asset received. So last-ditch effort, if you can't tell how much you gave up, then you tell how much you got. And the reason for that is the emphasis is placed on being as clear and accurate as possible with regards to the impact that these transactions have on you. And so it's easier to tell how much you gave up for something than how much you got. Because, if you get an asset, there could be repair problems with it, or it could be, a subpar model or whatever. You have no way of knowing that. But you do have a way of knowing exactly what you gave up. You know every detail about what you gave up. So it's just, the reason that's done is it's just a more clear, certain way of conducting business and recording your costs. So that's why we do it that way. Now, in terms of applying the cost principle to different categories, when we look at land, so just getting property in general, this could go anywhere from acquiring farmland to buying a lot, to renting a space downtown. Or sorry, not renting, acquiring a space downtown. It includes not only the purchase price, but also the related costs for land surveillance, legal fees, property taxes, clearing, filling, draining, etc. And when I say surveillance, I don't mean, buying a van and pulling up on the other side of the street and watching it for a couple days. Whenever you buy a piece of land, the land has to be surveyed. And what that means is that they send an expert in to determine if there's any outstanding issues with the land. So if there's if there's toxic materials or heavy metals or it covers a broad range of things, but basically you send an expert in to evaluate the land to see if it's suitable for zoning, to see what can be built on it, to see, what if anything is wrong with it, etc., etc. So acquiring the purchases that are associated with acquiring land can lump up any and all of these things. So it would be the price of the actual piece of property itself. I don't know why I drew a square there, but anyway, this is our imaginary piece. This is our imaginary lot of land. We acquire this piece of land, and all the associated fees that come with preparing this land for use would be lumped up and recorded in the acquisition cost of the land. So remember a few slides ago, that's it. So the price of the land plus any and all of those other things. Maybe all of them and maybe none of them. I mean, it won't be none of them, but I'm just saying there is a range there. There's flexibility in terms of what's included. Okay. Also, land is not amortized. Now, we're going to get to that in the next lesson where we talk about amortization, but I'm just putting that there just so you know. Land improvements. So land has to be maintained over time. Nature is very perseverant, and it has a constant influence on anything that's built on it. And so land requires regular maintenance to take care of it and keep it in working condition. So things like paving, fencing, signs, lighting, landscaping, these have useful lives and therefore must be amortized. You know, if you pave a driveway, eventually you're going to have to repave it or dig it out and replace it or whatever. All of these things will have to be maintained and replaced at some point, and therefore it's amortized. The life of a piece of land is indefinite because theoretically it could live forever, and therefore it's not amortized. Okay, buildings. So this includes not only the purchase price, but also the related costs in getting it. Hopefully you guys are seeing a pattern by now. With real estate, there's always legal fees involved, particularly with large buildings. The purchase of them and the sale of them is much more complicated. So there's legal fees involved in that, and costs to get the building ready for use, so renovations. So if you buy a building that was originally an office space and you want to turn it into a restaurant, then you're going to have to tear down some walls, and you're going to have to build a big kitchen and install appliances and stuff. And so those are all costs that are lumped in to the capital asset purchase cost. So if construction of a building cost includes construction costs, architect fees, building permits, evaluation costs, interest changes during construction, etc. So if you're building the building, then these are some other things that will have to be involved. Okay, and lastly but not least, equipment. So for equipment, the cost includes purchase price and other related costs. So shipping, assembly, installation, and testing. So going back to our restaurant example, if let's say you bought an old office lot, an old office space, like just a single story, tiny little office building, and you were turning it into a restaurant, then under the construction or under the building, the recording of the building, you would include things like tearing down the walls and renovating the walls and laying down the flooring for the kitchen and the plumbing and all that stuff. But then let's say if you were making bagels and you had to get a big bagel oven, you would not put that under renovations, because a big bagel oven, those big wood burning ovens where they put like 200 bagels in at a time, that's a giant piece of equipment. So you wouldn't put that big oven in renovations, you would put that under equipment. And so it's just something else to keep an eye out when you're making these recordings. So measurement after initial recognition. Under the historical cost method, the book value of the asset is not adjusted upwards when fair market value increases occur. Remember, we always go by the historical cost method. The only time we use fair market value is if the fair market value is less than the historical cost of getting it. Remember, we're always being conservative. So right now in Ottawa, you guys have probably heard about this at some point, that there's the real estate value of basically every building in Ottawa has almost doubled by now. It's insane. Like a lot of people, myself included, are finding it very hard to find a house that we can afford because when we'd started saving, we had planned for a certain price, and now any comparable building compared to what we wanted is almost doubly as expensive. So, I mean, it's more like 60%, but still. Um, but even the people who own these buildings won't record the fair market value of their house, even though it's increased by 60%. They still record it from the historical cost that they used to buy it, which might be much, much, much cheaper. My favorite example is cottage building became really popular about 50, 60 years ago. And I'm talking about like in Ottawa and Quebec. I'm not saying that cottage building was not a thing before that. It certainly was. But, during the population increase that happened back then, cottage building became really popular. And because there was so much land for sale in places like Quebec and Ontario in the unpopulated areas, the land went for really cheap. Um, like there are lots that used to cost $4,000, now they cost upwards of $150,000. And of course, inflation plays a role with that, but so do other factors like, again, the increases in population, the increase in overall value of real estate, et cetera, et cetera. So if you bought a cottage for $4,000, or not a cottage, but if you bought a piece of land for $4,000 and now it's worth 150, that doesn't matter as far as accounting goes. You still record it as the $4,000. Okay, another point. So measurement after initial recognition. So IFRS, the International Financial Reporting Standards, allows for business to choose to use the historical cost method or the revaluation method. Now, the current market value or replacement values are not used after an asset is acquired unless the values decline below the net book value. Now, we're throwing a lot of terms around. Remember earlier how I said that the only time you can use fair market value is if that value is less than the historical cost? Hopefully you remembered, I just said it a few minutes ago. So the condition in which you can use fair market value is if the net book value is less than if the fair market value is less than the net book value. Now, the net book value, which I believe is a new term, I'm not sure, but what it is the historical cost minus the accumulated amortization. So if the fair market value is less than the depreciated cost of the asset, then you can use it. See what I'm saying? So there's a condition to using the fair market value. It's not just is it cheaper than the historical cost. Is it cheaper than the net book value? Now, if fair market value, the rectangle. I hate this rectangle. It is the bane of my YouTube recording existence. If fair market value drops below net book value, or NBV, an impairment loss should be recorded no matter which approach is being used. Well, if you think about it, when you switch from fair market value to net book value, if it's less than the net book value, then you are essentially devaluing your capital asset, right? Because you're recognizing it as worth less than the net book value or the depreciated cost. So that difference is a negative value, and that's what an impairment loss is, because you're sort of flipping a switch and recognizing it to be less valuable than it is, or at least than it was, pardon me. Okay. Now, there are some specifics in terms of calculating the value for land, buildings, land improvements, and equipment. They're pretty basic and they're fairly boring. So I'm not going to go through them here. They're in your required reading on page 462 and 463. Now, one thing that I did want to talk about, because it's more interesting, is what's called a basket purchase. So a basket purchase is when you buy more than one capital asset at a time. And this is pretty common. And so what happens in that case is, for example, if you buy, let's say you buy a business, or actually I can't use that example because that has an intangible capital asset. If you buy land and the building on the land, which is fairly common, then the land will have a certain value and the building will have a certain value. And so a fairly common occurrence of a basket purchase has taken place. And so the way you deal with that, and just to be clear, there's an example on the top of page 464, which is super clear and very well broken down. I'll talk you through it here quickly, but I suspect the table will be easier to understand. What you do is you find the percentage of total cost that each item makes up, but you do that using their fair market value. So for example, if the fair market value of the house and the land put together is 160 grand, and let's say the building is worth 60 grand, then you take 60 divided by 160, and that gives you your percentage. Now, here's where things get a teeny bit tricky. You take that percentage that you got using the fair market value, and you apply it to the cost you spent acquiring it. Okay? So you use the percentage with the fair market value, and then you apply it to the cost of getting the asset. And that's how you record the separate values. Once you get it, it clicks and you understand. But I just wanted to be clear, because the specifics of the total costs for land, building, and equipment are pretty standard, pretty simple. But the basket purchase, in my opinion, merited some additional explanation. Okay, amortization. Now that's what's going to be in our next lesson. Just remember that amortization is an estimate of the benefit received from an asset over a period of time. So this is very specifically an accounting point of view of looking at it. Anyway, so it's an estimate of the benefit received from the asset over a period of time. Or to look at it another way, it's the process of allocating the cost of an asset over its useful life. What it's not is an asset valuation process. Those are two different things. So essentially, I prefer this method of allocating the cost of an asset over its useful life. This makes more sense to me, so I'd recommend sticking with this mode of understanding, but use whatever works for you. Because remember, the whole point of buying a capital asset is to help you produce or sell a product, right? So you are acquiring this thing to do a job for you. And so by amortizing something, you're allocating the cost of the asset as it's doing that job for you. And to me, that makes more sense. But again, you can think of it however you'd like. Whoa. Okay. So factors in terms of calculating amortization. So there's the cost, and we've talked about that. There's the useful life. All products and all pieces of equipment and buildings, etc., except for land, have a useful life, and that's why land's not amortized. And so now these useful lives are always estimates. They could be shorter or longer in real life, but there's always estimates that go with these things. And the other thing to keep in mind is the residual or salvage value. I prefer salvage value, but this is an estimate of the asset's value at the end of its useful life. So, once a car is broken down or once it's not useful anymore, you can still sell it, right? Even if you end up taking it to a junkyard to sell for parts, you can still salvage some value out of it. And that's why I put trade-in value or scrap value. Because when you get a car and after you've driven it for a long time, depending on the vehicle, you may not be able to sell it, but that doesn't mean that there's no value left. There's value in everything. And so when you're thinking of amortization, these are the three main factors that amortization is concerned with. But we're going to talk more about amortization in the next video. So anyway, there you go. Capital assets broken down. I hope you enjoyed the lesson. And I will see you in the next video. Okay, bye.